Take a look at yields. The yield on the 20-year bond is higher, now at about a couple-year high, 5.11, after the 1 p.m. auction that pushed yields up on the long end across the board, really.
On May 15th, 2025, the U.S. Treasury faced a disaster it didn't see coming. Its 20-year bond auction flopped, sending shockwaves through global markets. Yields soared past 5%, foreign investors pulled out, and the dollar took a hit. Just days earlier, Trump's massive tariff-packed tax bill passed, aiming to boost growth. Instead, it backfired. Hard. Now the U.S. is drowning in $1.8 trillion of debt, and the clock is ticking. Here's what really happened. In early May 2025, former President Donald Trump pushed a bold new tax bill through the House. At the center of it, a sharp rise in tariffs. 30% on Chinese imports and 10% on nearly all other goods. The goal was to protect American factories and reduce the trade gap by making foreign products more expensive. But within days, the financial markets began to shake. Instead of boosting the economy, the move added pressure to inflation and made U.S. debt less attractive to global investors. Higher import costs meant higher prices for everyday goods, electronics, clothing, cars, all becoming more expensive. That pushed investors to demand more interest on government bonds to make up for rising inflation risk. And the timing couldn't have been worse. Just as the government needed to borrow more, buyers started pulling back. The bond market took the hit and confidence in U.S. policy dropped fast. What was meant to be a show of strength turned into a trigger for panic, and the aftershocks are just beginning. On May 15, 2025, the U.S. Treasury held a $13 billion auction for 20-year bonds, and it was a complete disaster. Investors, both foreign and domestic, showed little interest. The bid-to-cover ratio, a key sign of demand, dropped to just 2.25. Well below the usual 2.5 average. Foreign buyers, who normally play a big role, backed off sharply. Only 56% of the bonds were picked up by indirect bidders, a steep fall from 70% the month before. Even domestic buyers pulled away, taking just 14.1% of the offering compared to a typical 17%. As a result, interest rates on long-term bonds shot up, with the 30-year yield jumping past 5.15%, its highest point since 2007. The message was loud and clear. Investors are losing faith in the U.S.'s ability to manage its debt. The failed auction rattled markets, sent gold prices up, and pushed the dollar down. For Washington, this wasn't just a bad day, it was a flashing red warning light. The failed bond auction couldn't have come at a worse time. Right now, the U.S. government is running a massive fiscal deficit, $1.8 trillion for 2024 alone, according to the Congressional Budget Office. To cover that shortfall, the Treasury needs to borrow more money almost every month, often $200 to $300 billion at a time. But here's the problem: when investors lose confidence and demand higher returns, borrowing gets more expensive. That's already happening. In the first 7 months of the current fiscal year, the government paid $580 billion just on interest, $65 billion more than last year. That number is rising fast, and by 2026, interest payments could overtake defense spending. It's a vicious cycle. More debt leads to higher interest, which leads to more debt. And when bond auctions start failing, like the one in May, the whole system looks shaky. This isn't just a number on a spreadsheet, it's a real threat to the economy. Tariffs were supposed to be a quick win, raise taxes on imports, bring in more revenue, and protect American jobs. But the reality is turning out very different. Since Trump's new tariff plan went into effect in May 2025, prices on imported goods have shot up. Everyday products, laptops, cars, appliances are suddenly more expensive. This isn't just a small bump. According to economists at Moody's, tariffs will cause higher inflation for U.S. consumers, forcing companies to raise prices and squeezing household budgets. Mark Zandi, chief economist at Moody's, said it best. Tariffs are inflationary by nature, and investors are watching closely. Rising inflation means the money they lend the government today will be worth less tomorrow. So they demand higher interest, which pushes up bond yields. Instead of helping the economy, the tariffs are making U.S. debt more expensive and harder to sell. What started as a trade policy is now a financial risk. As inflation creeps higher, the Federal Reserve is stuck. The Fed has kept interest rates steady in hopes of controlling inflation, which remains stubbornly above 3.5% as of May 2025. But Trump's team is calling for rate cuts to help struggling industries hit by tariffs. That puts the Fed in a tough spot. Lowering rates could make inflation worse, but keeping them high risks slowing the economy. This kind of mixed messaging is creating confusion for investors. When fiscal policy is pushing prices up and monetary policy is trying to slow them down, markets don't know what to expect. The result? Uncertainty and volatility. Bond buyers don't like surprises, and they're demanding higher yields to protect themselves. With no clear direction from Washington, confidence is falling. The fear is growing that the U.S. might be entering a period of stagflation, slow growth, high inflation, and rising unemployment. And if that happens, the damage could last for years. One of the clearest warning signs came from overseas. In the first quarter of 2025, foreign holdings of U.S. Treasuries fell by $97 billion, according to the Treasury Department's latest TIC data. China, once the largest holder of U.S. debt, cut its exposure to just $765 billion, the lowest in over 15 years. Japan, South Korea, and even Germany have also begun shifting away from treasuries, instead moving into gold and emerging market bonds. These countries aren't just rebalancing, they're signaling doubt in America's long-term fiscal path. JP Morgan CEO Jamie Dimon echoed these concerns in a May 2025 interview in Shanghai, warning that deficits, inflation, and policy uncertainty could drive the U.S. into stagflation. When foreign investors start backing away from U.S. debt, it forces the Treasury to rely more on domestic buyers, who are already demanding higher yields. That means more borrowing, more interest, and less control over economic stability. If the current trend continues, the numbers only get worse. The Congressional Budget Office projects that the U.S. deficit will more than double to $3.8 trillion annually by 2035. To fund that gap, the Treasury will need to flood the market with even more bonds, raising the risk of supply overwhelming demand. That doesn't just threaten debt markets, it could weaken the entire economy. The Penn-Wharton budget model warns that continued borrowing at this scale could shrink private investment in the U.S. by 13.6% by 2035. Why? Because government debt crowds out private funding. By 2045, the same model predicts a 17.6% hit to overall GDP growth. That's not just a long-term concern, it's a path to slower job creation, weaker wages, and fragile markets. The more debt we pile on without real reform, the closer we move toward a fiscal breaking point. Investors are watching, and they're already adjusting. In response to the growing economic pressure and the fallout from the bond market, the White House has gone into full spin mode, at least when it comes to headlines. Trump officials have promised an ambitious new plan, 90 trade deals in 90 days. It's a bold claim meant to reassure markets and project strength, but so far the results tell a different story. As of late May 2025, only one small-scale agreement, a limited trade deal with the United Kingdom, has been officially signed. Officials insist that several more are close, but no firm dates or details have been provided. The lack of follow-through is raising red flags. Behind the scenes, trade advisors claim the remaining deals are in the final stages, yet markets remain skeptical. Investors and analysts are no longer responding to promises. They want results. At the same time, interest rates continue to rise, inflation is sticking above expectations, and Treasury auctions are still struggling. The idea of 90 deals in 90 days might work as a campaign slogan, but it's doing little to restore real economic confidence. What global markets want now isn't a PR blitz. They want clear signs of fiscal discipline, strong trade partnerships, and economic policies that actually work. Until that happens, Treasury yields will likely keep rising, and investor trust will remain on shaky ground. The collapse of this Treasury auction isn't just a warning, it's a signal that the debt crisis is accelerating fast. Subscribe for weekly updates as we track every move, every number, and what it means for your future.